The dollar is slipping right now, and the people insisting it's just a normal drift are missing the one mechanism that actually moves FX when the room gets crowded. The yen doesn't just react to the dollar story. It can rewrite it, not with opinions, with math. And when that math flips quickly, the whole market has to reprice what it thought it knew about the Fed, about carry, and about what safe even means this week. Because here at the conflict nobody wants to say out loud. The Fed needs calm to keep financial conditions from doing the tightening for them, while Japan needs the yen to stop turning into a national headline. Those are two different mandates pulling on the same rope. And that rope is fraying right into the calendar window where liquidity gets weird and positioning gets defensive. And that's where the real pressure starts. If you're watching the dollar like it's a personality test, strong because America, weak because deficits, you're going to miss why it's slipping in the moments that matter. FX doesn't move on biography. FX moves on constraints, on rate expectations, on hedging flows, on who is forced to do what right now with no time to negotiate. And the thing that gets ignored in the mainstream play-by-play is that the dollar index isn't a single opinion. It has a basket, a weighted scoreboard. So when USD JPY snaps, it can mechanically tug the broad dollar picture even if everything else is still digesting. That's the hidden detail. It sounds boring until you realize it turns the dollar slipping story from a vague narrative into a measurable set of pressures you can actually track over the next 1 to 2 weeks. And later in this video, I'm going to give you the exact checklist, levels, scenarios, and what would invalidate the whole thesis. So you're not trading headlines, you're tracking forced behavior. But first, you need to see what just happened and why it matters now, not someday. Because this move didn't arrive politely, it lurched. The dollar against the yen went from looking comfortable near the upper end of its recent range to suddenly cracking lower in a way that doesn't happen on random Tuesday vibes. That kind of move usually means one of two things. Either somebody got a policy signal they weren't positioned for, or the structure of the market hit a tripwire. Option strikes, barriers, stop clusters, where hedging flows take over and the chart starts driving the news, not the other way around. And that's not the part most people are watching. They'll tell you the dollar is down because the Fed might cut, or the dollar is down because risk is on, or the dollar is down because politics. And sometimes those are adjacent, but adjacent isn't causal. The causal chain in FX is brutal and simple. Expectations of future rates drive yield differentials. Yield differentials drive carry incentives. Carry incentives drive positioning. Positioning determines how fragile the market is to a shove. And this week has multiple shoves lined up. If you want the why now in one line, it Fed week running straight into month-end flow dynamics, with a yen that just becomes sensitive enough that the market starts trading the risk of intervention as a live option. That's your calendar catalyst. That's your thin liquidity amplifier. And if one key level breaks, the math changes. Let's talk about the Fed risk first, because Fed risk doesn't just mean the rate decision. It means credibility risk. It means the market is looking at the Fed and asking, are you steering or are you reacting? If the Fed is expected to hold this week, and the street broadly does expect to hold, the decision itself is not the drama. The drama is what's implied about the path after the hold, the tone, the bias, the willingness to tolerate tighter conditions, the sensitivity to political noise and institutional pressure. You don't need a conspiracy to see that incentives matter. When markets are calm, the Fed gets optionality. When markets are disorderly, the Fed gets boxed in. And traders aren't stupid. They smell that box before it closes. So when you hear Fed risk translated into uncertainty in the expected rate path and uncertainty in the Fed's reaction function, that uncertainty doesn't always show up first in stocks. It often shows up first in the most honest casino on earth, FX. Because FX is the cleanest expression of relative policy, not absolute morality, relative policy. And when that relative policy picture gets muddier, the dollar can start slipping even without a clean narrative. But here's the twist. The yen is not just another currency in the background. The yen is the funding leg of the global appetite machine. When global players want to lever up into higher yielding assets, the yen has historically been a convenient low yield source of funding. Borrow yen, buy something that yields more, clip the spread, rinse. Repeat. That's carry. And carry trades are like stacked dishes in a busy kitchen. They look stable until one plate shifts, and then suddenly everyone is grabbing at once. That's where the real pressure starts. When USD JPY drops hard, it's not only telling you something about Japan, it's telling you something about the global positioning built on top of that funding dynamic. Because if the yen strengthens quickly, the cost of holding that carry exposure spikes through the back door. You get margin calls. You get risk managers telling traders to cut gross. You get forced buying of yen to close funding exposure. And that forced buying can cascade, not because everyone loves Japan, but because everyone is managing the same risk at the same time. Short covering mechanics and effects are simple. If you were short yen, long USD JPY, and the pair starts falling through levels, your loss grows as the yen strengthens. At some point, either your stop hits, your VAR spikes, or your prime broker changes the conversation. And then you don't choose to cover, you cover. And when you cover, you buy yen. That pushes the yen higher. That pushes USD JPY lower. That triggers more covering. Reflexivity. The chart becomes a pressure system. But that's not even the most underappreciated accelerant. The quiet accelerant is options. This is the part most people never see because it's not on the front page, and yet it moves price like a magnet in a slingshot at the same time. FX options markets are filled with big strikes, round numbers, popular hedging levels, structures tied to corporate hedges, barrier options, that create zones where dealer hedging flips from dampening to amplifying. Here's the clean version. Dealers who sell options hedge their exposure in spot. If the market is pinned near a strike and dealers are effectively short gamma, then as spot falls, they have to sell more to hedge, which pushes spot further down. Or as spot rises, they buy more, pushing it further up. Short gamma environments can turn a normal move into a fast move. That is why sometimes price feels like it is sliding on ice instead of walking on pavement. And when you're dealing with a pair as heavily traded as USD JPY, you can get pockets where a break triggers a wave of hedging that looks like mystery momentum. It's not mystery, it's dealers doing math. And that's the next detail that flips the whole setup. Now loop back to the dollar index for a second, because this is where the hidden detail bites. The dollar index is heavily influenced by a handful of major currencies, and the yen is not a footnote. So if USD JPY is moving violently, it can mechanically weigh on broad dollar measures, even if EUR USD is sleepy or GBP USD is waiting for its own catalyst. That means a lot of commentary about the dollar slipping. We'll wrongly attribute it to whatever headline is trending. But the structural reality is, if the yen strengthens sharply, it can pull the basket lower, and that basket move itself then becomes a narrative that influences positioning and risk sentiment. So you get feedback loops, yen move pressures, the broad dollar gauge, broad dollar weakness then gets interpreted as Fed dovishness. That interpretation then changes rate expectations. Those expectations feed back into USD JPY via yield differentials. That's the loop. And once you see that loop, you stop arguing with strangers about the dollar story or wishing to and you start monitoring the parts of the machine that actually transmit force. Because if one level breaks, the math changes. Okay, so why is the yen suddenly the knife edge? Japan's relationship with a weak yen is complicated. A weaker yen can help exporters translated earnings. It can import inflation through higher energy and commodity costs. And it can become politically toxic when the move is fast enough to hit households at the gas station and grocery store. Japan can tolerate a weak yen. What it can't tolerate, historically, is disorderly weakness that looks like a one-way trade with no counterweight. And when the market senses that policymakers might prefer order over drift, traders begin to price the risk of intervention. Notice the phrasing, the risk. FX doesn't require the intervention to actually happen to change behavior. The credible threat changes positioning. The uncertainty widens, spreads. The fear of a sudden air pocket forces traders to reduce leverage. And that reduction can strengthen the yen all by itself. This is the paradox. The more one-sided the yen weakness becomes, the more likely policymakers signal discomfort, and the more likely the market starts pre-hedging against a reversal. That pre-hedging can be the reversal. And when it happens around big levels, those round numbers that attract every stop in every hedging program, it doesn't look like a gentle correction. It looks like a snap, and that snap is what makes the dollar slip feel sudden. Now layer in the macro regime question. The US has been the world's high-yield major for a while, and that gave the dollar an easy base of support. But base support is not the same as upside momentum. The moment the market thinks the peak in US rates is behind us, or the moment it thinks the Fed is more likely to ease into weakness, the dollar, where S carry advantage, starts to feel less permanent. It doesn't need to vanish to matter. It just needs to be less certain. FX trades on relative certainty. If the path is clear, money piles in. If the path becomes fog, money trims exposure. That trimming is selling pressure. And with month-end rebalancing, that selling pressure can be amplified by flows that have nothing to do with anyone's macro worldview. Funds rebalance, corporates hedge, pension allocations adjust. Those flows are mechanical. They don't care about your thesis. They can temporarily overwhelm it. And that AWS is why this week matters. Fed communication risk plus month-end flow risk is exactly the kind of environment where the market can overshoot, shake people out, then reveal the true direction after the dust settles. And that's where retail investors get emotionally mugged. We'll deal with that in a minute, because your psychology is part of the trade whether you like it or not. But first, let's build the proof stack, multiple layers. So we're not relying on one fragile argument. Proof point 1 is price behavior itself. The dollar has been hovering in the high 90s on broad measures, not collapsing, but losing that invincible posture. That matters because markets don't break from the top with fireworks. They break by failing to make new highs, by losing momentum at resistance, by reacting more violently to bad news than to good news. When the dollar stops being rewarded for good data and starts being punished for not perfect data, that's a regime tell. And you can feel it in the tape. Proof point 2 is rate path ambiguity. The market largely expects a hold this week, which means positioning into the decision is not about the decision. It's about the guidance. And when guidance is the focal point, volatility can explode because guidance is narrative sensitive. One phrase can shift expectations. One inflection can reprice the front end. And in FX, the front end is everything. Proof point 3 is the yen's role as a funding currency. And when yen moves get sharp, you often see broader risk management tighten. That can show up as degrossing and leverage strategies, reduced appetite for crowded trades, and a general cut leverage vibe that hits currencies first. Proof point 4 is options and hedging structure. When USD JPY breaks levels quickly, the move often has the signature of hedging flow. Fast, clean, relentless for a stretch, followed by a violent bounce that feels like a trap. That bounce is not the trend is over. Often, it's dealers flipping hedges as spot moves away from strikes or short-term players taking profit into liquidity pockets. The signature matters. Proof point 5 is cross-market trust signals. When hard assets like precious metals are catching a bid at the same time currencies wobble, that can signal a shift in how the market is pricing credibility and long-term purchasing power. It doesn't mean gold up equals dollar down in a simple way. It means the market is pricing uncertainty about fiat stability, fiscal paths, and policy trade-offs. And uncertainty is poison for a currency whose strength depends on confidence and steady rules. Proof point 6 is global relative policy drift. Japan has been inching away from the most extreme forms of monetary accommodation, and even if the steps are small, the direction matters, because the yen is priced off expectations of Japan staying the outlier forever. If the outlier status fades, carry loses its free lunch feeling, and the market reprices that risk in bursts, not in smooth curves. That's the proof stack. Price behavior, policy path ambiguity, funding dynamics, option structure, trust signals, and relative policy drift. And now the counterpoints, because if you can't articulate the counterpoints, you don't have a thesis, you have a mood board. Counterpoint 1. Risk off can still spike the dollar. In a true panic, global demand for dollars can surge because dollar liquidity is the plumbing of trade and debt. That can overwhelm the dollar slipping theme temporarily. Counterpoint 2, U.S. yields can reassert dominance fast if inflation surprises, growth surprises, or the Fed leans hawkish. FX is sensitive to the front end. A quick jump in short-end yields can put the dollar back on its feet. Counterpoint 3, Japan's yen support can be more talk than action, and markets can fade it if they sense reluctance. Counterpoint 4, USD JPY could be correcting a crowded position rather than starting a new trend. A crowded trade can unwind sharply, then stabilize, then rebuild. That's why you need levels and confirmation, not just a story. And counterpoint 5, other components of the dollar basket matter too. If Europe weakens, or if risk spreads shift, the dollar can find support even as USD JPY drops. So we're not declaring the dollar is doomed. We're identifying a near-term pressure regime with specific triggers. And that ES, where the real payoff is, you can map a what to watch next instead of arguing about ideology. Now let's get very practical. What happens next week, what levels matter, and what would confirm or invalidate this setup. Start with USD JPY because it's the live wire. The rough zone around the mid-150s is a tell area right now. If the pair remains heavy below prior breakdown points, if rallies feel sold quickly, if it can reclaim the levels it just lost, that suggests the move was not a one-off headline spike. It suggests positioning and hedging are still unwinding. Watch how it behaves on bounces. Does it bounce and then grind lower again? That's pressure. Does it rip higher and hold above the former breakdown region? That's stabilization. And stabilization is not the same as bullishness, but it changes the odds. Now watch the broad dollar gauge around the high 90s area. If broad measures hold above support and snap back quickly, it tells you the dollar still has structural demand, maybe via yield, maybe via risk off. If it breaks lower and struggles to recover, it suggests the market is more willing to price a softer Fed path, or at least less confidence in sustained dollar dominance. But the single most important near-term tell isn't a headline, it's the reaction function. When the Fed communicates this week, does the market interpret it as still restrictive, still vigilant, or ready to be flexible? You'll see that in yields immediately, and then you'll see it in USD JPY. Because if the front-end yields soften, the carry advantage narrows, and the dollar loses one of its easiest crutches. But here's the micro cliffhanger. Even if the Fed is hawkish, the yen can still strengthen if Japan's side of the equation becomes more urgent. That's the collision. Fed risk plus yen pressure, two different forces, same trade. And this is where month-end and thin liquidity turn the collision into a pileup. So here's your two scenario lens because this keeps you sane. Scenario one is the controlled pullback and retest. In this scenario, the dollar continues to slip but not implode. You see choppy price action. You see bounces that get sold. You see support levels tested, reclaimed briefly, then tested again. This is the market digesting and redistributing risk. It's messy, it's emotionally exhausting, and it's exactly how markets shake out weak hands while building a new positioning base. In this scenario, confirmation looks like failed retests. The dollar tries to reclaim a broken level and can T-hold it. USD JPY bounces into resistance and rolls over. Volatility remains elevated but not catastrophic. And cross-market signals, like metals staying supported, suggest the trust bid is not fading. Scenario 2 is the continuation squeeze, the gap risk scenario. This is where you get a sharp continuation move in USD JPY that forces short yen positions to cover into illiquid pockets. You get the air pocket behavior, fast moves in minutes, not days. You get widening spreads. You get frantic commentary explaining it after the fact. This scenario can happen around policy events, around month end, around surprise headlines, or simply because a key option barrier gets taken out and hedging flips from dampener to amplifier. In this scenario, the dollar can slip broadly because the yen component drags the basket, and because the market interprets the chaos as a signal of policy stress. But here's the warning. In a squeeze scenario, you can get violent counter moves too, snapback rallies that feel like the trend is over. They're often just position resets. That's why you don't marry the first candle. You track behavior across levels, and that is not the part that matters to most viewers. Most viewers will be emotionally hijacked by the speed. Which brings us to the psychology shield, because this is where people get wrecked even when they're right. Volatility is a weapon, not because there's a villain twirling a mustache, but because the market is an ecosystem of incentives. Big players can absorb volatility. They can hedge it. They can use it to enter and exit. Smaller players feel it as pain. So the game becomes create enough emotional turbulence that retail sells lows and buys highs and then call it discipline afterward. The trick is predictable. First, you get a sharp move that triggers fear or euphoria. Then you get a reversal that makes you question your sanity. Then you get a second move in the original direction that leaves you emotionally depleted and underpositioned. That's how the market taxes impatience. So your shield is simple. Separate trend signal from noise. Trend signal is what happens at key levels after the event risk clears. Noise is the intraday spike that exists because options hedging and thin liquidity are doing their thing. Trend signal is the inability to reclaim broken levels on multiple attempts. Noise is the first bounce that gets everyone tweeting V-shape. Trend signal is how yields behave after the Fed. Noise is the 10-minute candle that prints while everyone is reading a headline. If you can keep those categories separate, you stop donating emotional liquidity to the market. And that's where the real pressure starts, on everyone who can't. Now, let us make this even more concrete with a what to watch next checklist that doesn't require you to be a chart wizard. 1. Watch how USD JPY behaves around the levels it just broke. If it keeps rejecting rallies, pressure remains. 2. Watch short-end US yields into and after the Fed communication. If the market starts pricing a softer path, the dollar's carry advantage erodes. 3. Watch volatility. Not the price, volatility. Rising implied volatility in FX tells you hedgers are paying up for protection, which often coincides with unstable positioning. 4. Watch cross-asset signals that reflect trust and liquidity, metals, strength, credit spreads, and any signs of funding stress. You don't need exact numbers to see the direction. 5. Watch the tone out of Japan. Official discomfort, commentary about disorderly moves, anything that increases the perceived probability of action. Remember, perception alone can move positioning. And 6. Watch the broad dollar gauge relative to its recent support zones. If it slides and can't recover, that's regime pressure. If it snaps back and holds, then the slip may be a temporary unwind rather than the start of a deeper move. Here's the invalidation logic, because this is the part that keeps you honest. If USD JPY cleanly reclaims its breakdown zone and holds above it for more than a brief spike, then the unwind pressure is likely easing. If US yields push higher and the Fed messaging is clearly more hawkish than expected, that can re-strengthen the dollar quickly. If risk markets wobble hard into a global risk-off episode, dollar demand can surge as a liquidity reflex. Any of those can blunt or reverse the slipping narrative, temporarily or structurally. And if those happen, you adapt. You don't argue with your screen, because the only thing worse than being wrong is being stubborn. Now, let's talk about why this matters to finance-minded retail investors in the commodities crowd, because you're not watching FX for entertainment. A slipping dollar changes the global pricing of commodities, but more importantly, it changes the psychology of scarcity and trust. If the market thinks the dollar's dominance is less stable at the margin, real assets get a bid. If the market thinks policy is less predictable, hedges get more expensive, and volatility becomes a cost center. For metals and commodities watchers, the dollar isn't just a currency, it's the measuring stick. When the measuring stick wobbles, everything priced in it looks like it's moving more. That can create feedback. Higher commodity prices feed inflation expectations. Inflation expectations feed Fed path debate. Fed path debate feeds FX. FX feeds commodities again. Reflexivity is not a buzzword. It's the loop you're living in. And if the yen is the trigger this time, the loop can accelerate because USD JPY is so deeply tied to global leverage. That's why this isn't a niche FX story. It's a global positioning story wearing an FX mask. And here, the quiet part that people do not like to admit. Institutional flows done that need your permission. If large funds rebalance at month end, if corporates adjust hedges ahead of policy risk, if dealers hedge option books aggressively, price will move whether or not the narrative is clean. That's why you're seeing a slip instead of a tidy trend line. The market is digesting multiple constraints at once. Now, one more micro cliffhanger before we close. The biggest tell you Walget isn't T, the headline after the Fed, it's the day after the Fed. That's when the market shows whether the move was emotional or structural. Does the dollar keep getting sold on rallies? Does USD JPY stay heavy even when the news cycle calms down? Do spreads and volatility remain elevated? That's the confirmation window. And if you're watching that window, you're already ahead of 90% of the commentary ecosystem. So here's the subtle CTA, because I'm not here to beg you for likes. I am here to build a crew of people who don't get farmed by noise. If you want to stay on top of this the right way, think like a mechanic, not a poet. Track the forced behavior, track the levels, track the calendar, track the hedging. And when the next volatility wave hits, remember, the market will try to make you feel late, then punish you for chasing. Don't let it. Keep the two-scenario lens. Scenario 1, controlled pullback and retest, choppy, frustrating, but tradable if you respect levels and patience. Scenario 2, continuation squeeze, fast, emotional gap risk, where the only edge is not being emotionally hijacked. In both scenarios, the thesis can be right and price can still whip around violently. That's normal. The goal isn't to predict every wiggle. The goal is to know what would have to be true for the bigger move to continue and what would have to break for it to fail. If USD JPY remains heavy below the key breakdown region and the dollar basket keeps failing to reclaim its recent support levels, the slipping pressure stays alive. If the Fed messaging leans into flexibility and the market prices an easier path, that supports continued softness. If, instead, the Fed surprises hawkish, yields jump, and USD JPY reclaims and holds above the lost levels, then the slip likely becomes a shakeout rather than a regime shift. That's the whole game in the next 1 to 2 weeks, forced flows versus regained confidence. And as always, don't confuse a loud candle with a real trend. The market will try to weaponize your attention. Keep your checklist. Watch the calendar. Watch the reaction, not the speech. And watch the yen, because whether people admit it or not, the yen is the lever that can move the whole dollar story when positioning is tight and the room is crowded.